But like when you start viewing life insurance as really kind of just two things, term and permanent. Like let's just start there. But if you have term life insurance, it's meant to solve a certain problem, a temporary problem, and we know that based on the insurance carriers that they know that those windows of opportunity have a risk, whether a 55-year-old is going to die between 55 and 65, like they judge that risk and they know it's, less than 1%, so you can get this much coverage or whatever the case is. But they know between 85 and 95, like, wow, there's like a 92% chance this person is going to pass in this window. Like it's a higher risk and a higher, like, so we know that, if you have a 35-year-old in a term plan, like what it's meant to cover and what it's meant to do. When you can picture it from, because that's like mortgage protection. It's a temporary problem. It's cover my mortgage for a certain amount of time. It's until I can pay it off or until there's an end date in mind to get it. So most people come to the conversation with a term mindset for this amount of time. When people start talking about like, well, I want to pay it off. So like we know term is a financial contract that covers you for that amount of time. So start viewing term as like it's a stack of papers. It's a contract that you can go to the courts and say, hear ye, they signed this contract and give me my $500,000. And they have to, by law, adhere to it as long as you do your part, which is pay your monthly premiums. There's an agreement. It's a stack of papers. On the permanent side, think of it more like a bucket, right? It's a bucket because it's part of this investment conversation, and many times because you're looking at the cash value that it builds.